One of the more interesting components of behavioral finance is what's called recency bias, which by definition, recency bias is when you get new information and hold it in higher consideration or see it to be more valuable than maybe older information going further back in history. So it's really what's in your recent memory. So another way to say that would be when we're talking in context of the markets or portfolio allocation, that what has performed recently is going to continue to perform well in the future. There's also a term that really goes hand in hand with recency bias, which is called herding, which is when investors buy the same stocks, trade in the same direction at the same time. It's kind of like the stock of the week. Everyone is owning the stock, they're seeing it all over the news, so investors pile in. That's herding. So the reason I'm bringing this up is I see a lot of portfolios still until today, where we're in February of 2023, that are very highly concentrated in those large cap, or I should say mega cap growth technology companies. Of course, talking about Google, Apple, Amazon, Facebook, Netflix, etc., which absolutely in the past 5-6 years have significantly outperformed the rest of the market. But if you look further back in time and try to put that recency bias aside, since the inception of the markets in the 1920s, value historically outperforms growth by about a margin of over 4% per year. Bank of America did a study using the Russell 1000 Growth Index and the Russell 1000 Value Index since the inception of the markets, and found that the Russell 1000 Value Index returned 1,300,000% returns to shareholders versus the Russell 1000 Growth Index returned about 600,000% to shareholders. So the value index outperformed by about double. Now, of course, that's going back, 80 years. So all that's going to depend. That's assuming you put your money in, you never touched it, you never added money, you never took money out, you were in the whole time. So certainly there's going to have to be some research done and consideration for what's going on in the economy at the current moment. And I think it's important to mention also that growth stocks, again, we're coming off a period of 10 years where growth absolutely did outperform value. Before that, in the 10 years prior, 2000 to 2010, it was value that outperformed. Now, you could say that the large technology companies have really fundamentally changed the market, and they're going to continue to perform well. But that was the same argument that was made in the year 2000, right before that tech bubble, and we went into a period where value outperformed. Also, value tends to outperform particularly when interest rates are rising, when inflation is high, or the economy is in recession. All that's kind of up in the air right now as far as the recession, but certainly interest rates are rising and inflation is high. So I would say if you're allocating a portfolio, try to put the recency bias aside. Don't concentrate your portfolio in those 5 or 6 large cap stocks that everyone owns, because the probability that they're going to outperform the market going forward for the next 2, 3, 5 years is relatively low. Create a diversified portfolio, manage that portfolio, shift it from time to time depending on what's going on with the economy and what's going on with the markets, but don't concentrate it in those positions. And I would also say there was an interesting study by Vanguard that found that a buy and hold strategy, and I'm not saying buy and hold and never change the portfolio, but a diversified buy and hold strategy outperforms a profit chasing strategy across every single asset class. So I would say a diversified portfolio, a plan, someone to manage that plan, and make sure that you're looking at the macroeconomic scenario, and make sure that you have value included in your portfolio alongside those growth stocks. Thanks, everyone. Hope this was helpful.